Good morning and welcome to Managerial Accounting as we approach the end of the semester here. Today we will be finishing up chapter 27. So you should be able to submit the chapters 27 exercises for grading by the end of the day today. Looking ahead then to next week, we have our last two regular classes and we will be covering chapter 28. 100% sure that chapter 28 will not take us 2 full class periods. So we may be talking on Tuesday about, do we want to do this in just one class and kind of rush through it? I don't mean it like that. We'll go as slowly as we need to. But we can decide whether we want to have 2 shorter classes or 1 regular length and 1 maybe super short class. It may all fit into 1 class depending on how things go. Either way, none of the due dates will change. So we follow the regular pattern, pre-quiz on the day we start the chapter, exercises on the day we should be finishing the chapter, problem then the next class day. As you know, May 10th is a regular class day, but we will not be covering new material. So we consider that a review class. You should plan to attend if there is anything you need to go over, even if it's the chapter 28 problem or anything from the practice set for the exam. But in reality, once we finish class on Thursday or finish chapter 28, there is no more new material and you can determine for yourself how quickly you want to move through the chapter 28 problem and then the exam. Friday, May 13th will be the final day to submit any work for this class. So that includes anything that you've been working on in CNOW. If you haven't submitted it for grading, you need to do that by the 13th so it gets included in your final grade calculation. Final grades are due on May 16th. So after the 13th, so starting on the 14th, I will be putting zeros into the Blackboard gradebook for anything that hasn't been submitted in CNOW or for the project if you hadn't written the project. So any questions about what's coming up? I know I'm saying this every class and it's in the announcements, but it's really important that people have that timeline in mind. Okay. Flexible all throughout the semester, but there is no flexibility past the 13th. So last class we started talking about lean manufacturing and we did together or at least discussed the first 5 exercises. So we're going to be picking up today with the idea of lean accounting and how we can apply some of the lean principles in the accounting realm. So most of what we talked about last class was related to the actual manufacturing of the product. But I said you can apply these lean principles even in a service organization. So clearly it doesn't just apply to making a product, that there are efficiencies that can be realized in any activity that we do within the organization. And so today we will be talking at first about how do we apply some of these lean principles within the accounting office or department. There were 2 videos that are linked in the reference materials folder for this chapter in Blackboard on Toyota and the pioneering of lean manufacturing. If you have not had a chance to watch those, it'll take you less than a half hour to watch both of them. So please make sure you do that. Before we start with the lean accounting for today, does anyone have any questions, comments, anything? We'll go to that. You know, I was in a training. Some of you may have heard this. I don't know if I've said it, but you may have heard it other places. SUNY is transitioning away from Blackboard to a new learning management system called Brightspace by a company called Desire to Learn, or D2L. Excuse me. And JCC was selected to be in the first cohort to transition. So we are starting with Brightspace this summer. Some summer classes will be on Brightspace and some will still be on Blackboard. For fall, all of our courses will be in Brightspace. So summer is kind of a pilot for some classes. The only reason I'm mentioning that is I've been doing some trainings for Brightspace, and one of the training presenters this week, the trainings are on Zoom, they're live, and one of the training presenters actually talked about how he's looking at his screen and he doesn't want people who are on Zoom to feel like he's not looking at them. And I thought it was funny because to me, it's 2022. I think everyone knows that there's only one camera, and if you're looking at the camera, you're not actually looking at people anyway. But he felt that he needed to point out that he wasn't trying to be rude by not looking at you, meaning not staring into the camera. Because I try to make sure I look at the camera as well as the people who are in the classroom. But I just thought that was kind of interesting, that he felt he needed to apologize for not looking straight into the camera the whole time he was presenting. It's an interesting world we're living in. So let's look at lean accounting. If you have not already opened your See Now exercises, now would be a good time to do that. We'll be starting with exercise 6 here in just a couple minutes after we talk about this concept of lean accounting. So in order to take those lean principles of trying to reduce waste and inefficiency and really targeting any time spent or effort or money spent on systems or activities that don't add value for the customer, clearly the accounting area is one of those places that we can achieve some efficiencies. Mainly because our customers really don't care about our accounting system. It doesn't really affect them as long as we continue to make a quality product at a low price. And so if we say that most or all of the accounting that we do is not value adding to the customer, then that's definitely a place that we can pinpoint or target for reducing waste inefficiency. How do we do that? Well, you can see a couple examples on this screen of ways we can do that within our accounting records. Recording fewer transactions. Does that mean that we can skip transactions that say affect cash? Of course not. We always would need to record any accounting transaction that affects our cash. But are there transactions that we can lump together, group together? And before I go into an example, let me just highlight the second one as well. Maybe there are accounts that we can combine and so here's what I want to talk about. Back in chapter 15 or 16, very beginning of the semester, I have in Blackboard a flow chart that's literally a picture, a photo of a whiteboard where I had drawn out all of the accounts for a traditional manufacturing system where you move through raw materials into work in process, into finished goods, and then onto the income statement as cost of goods sold. So if you think about a single raw material and all the transactions that get recorded for that single raw material, we purchase it, we record the purchase and the payable or the payment of cash, it goes into raw materials. Then we do another transaction to move it into work in process. Then we do another transaction to move it into finished goods. And then we do, like the 5th transaction to move it into cost of goods sold on the income statement. 5 transactions. Yet under lean manufacturing, we expect that the vast majority of the product that we make in a given period gets sold in that period. Because of that emphasis on pull through production. We have an order for it, we make it, we sell it. So wouldn't it be more efficient to record all of the transactions in the account where they're most likely to end up at the end of the accounting period, and that is cost of goods sold? And only at the end of the period do we look at that and say,
Okay, but did we really sell all of this? Is some of it still raw materials? Is some of it still work in process? Is still some of it in finished goods and not actually sold? Wouldn't that be more efficient? Instead of 5 transactions for every piece of raw material, 1 transaction recorded in cost of goods sold, and then at the end do an adjustment to bump that stuff backward. We actually call it back flush accounting when we do that. When we start with the end in mind, most of it's going to be sold. And at the end of the period, end of the month, of the quarter, the year, we look at that account and say, but did we really sell all of it? And then simply do an additional transaction adjusting entry to reclassify some of that cost that hasn't actually been sold. Can you see why that would be more efficient? Under traditional manufacturing, maybe not, because we have much more that's still sitting in raw materials, much more that's still in work in process or finished goods when we're producing for inventory. But under pull-through production, under those lean concepts, it absolutely would be more efficient to start with the end in mind. Most of it's going to end up in cost of goods sold. So let's just start with it in cost of goods sold and then make any necessary adjustments. You can see an additional idea here. Rather than having separate accounts for raw materials and work in process, if we're trying to limit or eliminate both of those as inventory that's being carried forward, maybe it's okay to have just one account for both our raw and our work in process inventory. That's another way of reducing transactions. We have talked about since the work, what was it? Chapter 17, yeah, right? I think it was chapter 17 when we talked about process costing. We have been thinking about direct labor and overhead as a combined conversion cost, and yet we still did entries for each one of them separately, independently. Maybe it would make sense to look at them as just one category, because we've been talking about them as one category since chapter 17. And so maybe we have a separate account for, or a separate entry for conversion costs, not 2 entries for direct labor and the overhead. We'll talk about, toward the end of class today, some non-financial performance measures. So how do we look at things that beyond just the dollars and cents that we're recording in our accounts? And also using lean manufacturing in combination with activity-based management or activity-based costing that we covered in chapter, that might have been chapter 18 or 19. We can trace more costs directly to the product. We have less of the indirect costs. And so that allows us to more closely track our costs and understand where the costs are coming from if we are able to trace those costs more specifically to a product. And that will be easier to do if we are using those lean principles. So as we talked about it on Tuesday, if we arrange our manufacturing in those nimble, flexible work cells, so we actually physically configure our plant differently, it is easier to see if this production line is only for product A, it's easier to see the work that happens for product A compared to product B, which is over there or in a different room. So it does allow us to have a better handle on our costs because we can see exactly what's happening for product A, because it's not all of the cutting implements that are in one room and the finishing implements that are in another room, but everything for this product happens in one coherent fashion, one product production line, if you want to think of it like that. Okay. All right, you talked about back flush costing. So that. If we are using just-in-time inventory, then we don't have that warehouse where we have raw materials sitting around. It makes it easier from an accounting standpoint to enter those transactions directly into work in process, or as I said, even directly into cost of goods sold and then back flush it into raw and work in process at the end of the period when we have a much lower dollar amount left in production. I think at this point, yeah, we can go to our first exercise for today. So hopefully everyone has their exercises open. We'll get started with exercise 6. Westgate Incorporated uses a lean manufacturing strategy to manufacture DVR players. The company manufactures DVR players through a single product cell. The budgeted conversion cost for the year, so we know that that's direct labor and what we've considered as overhead. The conversion cost for the year is $600,000 for 2,000 production hours. Each unit requires 21 minutes of cell process time. During March, 500 DVR players were manufactured in the cell. The materials cost per unit is $60. The following summary transactions took place during March. So we purchased some materials. We purchased only the materials we thought we would need for March. Again, that concept of just-in-time inventory. We don't order it just because we can, just because we have storage room for it, because we know that incurs additional cost. Excuse me. Number 2 says we applied conversion cost to our production. 3, we made 500 DVR players and we sold 480 of those players. So at the end of the month, at the end of March, we have 20 players still in finished goods. So let's determine the budgeted cell conversion cost per hour. Let's show you. I think it's intuitive, but I just realized I should have let you copy down this formula. Again, I think it just makes sense if you think about it. The cell conversion cost rate is the budgeted conversion cost. How much do we expect to spend on it, divided by the planned hours of production. So you may want to make note of that formula. That's what we'll be using for this first step. So budgeted cell conversion cost per hour. See, we have $600,000 is our budgeted conversion cost, and that's for 2,000 hours. Oops. And so we determine that the conversion cost per hour is $300. Everybody okay with that? I think, as I said, I think it's intuitive, but the next step, determine the budgeted cell conversion cost per unit, so meaning per DVR, and our budget requires 21 minutes of cell process time. So if we have our per hour cost of $300, $300 per hour, we're going to multiply that by the 21 minutes that it's going to take us. We only want 21 minutes worth of cost per DVR. So I labeled that per DVR because I wanted it to be clear that when we say per unit, we're talking about unit of the product.
So now with that in mind, and we know our direct materials cost per unit is $60. So the first journal entry we need to do, materials were purchased for March production. And so one of the advances, one of the improvements or efficiencies of using lean manufacturing, I guess I can erase those now since I put them into the cells for A and B. So one of the improvements that we just discussed would be, rather than having raw materials separate from work in process, we look at that as just one account. And so we eliminate one transaction as we request materials, move them out of raw materials into work in process. They're already there. We've eliminated a transaction from our traditional approach. It doesn't say how we purchase them. So since there isn't an option for cash, I'm going to assume that the credit side is to accounts payable. Assume we bought them on credit. Now we're using that concept of just-in-time inventory, and so we would have only purchased materials for the DVRs we expected to make. It tells us that 500 DVRs were manufactured. We aren't given any additional information about how many they plan to manufacture. So the assumption I will need to make is that they made all of the units that they expected or planned to make. But that's really the difference, as we've discussed in earlier chapters, between our expected or normal capacity and our practical capacity. Did we make as many as we had planned to make? Because we aren't told any differently, I assume that we did. So we ordered materials for 500 DVRs at $60 each, for a total of $30,000 that gets added to our raw and in-process inventory. As I've already suggested, an additional or different way of looking at this would be to put those directly into cost of goods sold. But that's not what we are doing in this particular exercise. It's just another option, another option. Conversion costs were applied to production. So our conversion costs are $105 per unit based on the budget. $105 per unit for 500 units is $52,500. And so under traditional manufacturing, we would have a separate account for our labor, direct labor, our separate account for the direct materials, a separate account for the overhead. For lean accounting, to make this simpler, more efficient, we have one account where we lump together our overhead with the direct labor. What we are applying to our raw and in-process inventory is based on the budget. So I can't tell you now which chapter it was in, but several chapters ago, we talked about the concept of normal costing, where we move through our accounts the cost based on the budget, based on our standards. Oh, so yeah, so that would have been, what, I think chapter 23 maybe, standard costing and variance analysis. And so that's what we're doing here. We're applying costs, we're moving the costs through our system, through our accounting records based on the budget. And we're putting the actual costs, in this case, into that conversion cost account. And at the end of the month, we're going to do a reconciliation, or at the end of the accounting period, we'll do a reconciliation to see what's in that conversion cost account in the same way we did that for the overhead account. It will now apply both to the direct labor and the overhead, because we're lumping them together as conversion costs. So we'll be debiting
into the conversion cost account the actual costs, we're crediting moving out of that account based on the budget, based on the $105 per unit that we expected to spend. And at the end of the month, then whatever's left in that conversion cost account, if anything, will be the variance that we can then explain as we covered in that variance analysis chapter. What's next? 500 DVR players were assembled and placed in finished goods. 500 players. The cost per player is $60 for the raw materials plus $105 for those conversion costs, a total of $165 per player. And we finished 500, so 500 at $165, $82,500 is going to be moved out of the raw and in process and into finished goods. That looks exactly like what we have been talking about since chapter 15, with the exception, with the single difference that these are not actual, but are budgeted costs based on our standards. For step 4 then, we sold 480 of those players. So you can see that this is a 2-step entry. We have to record the sale and relieve the inventory. Thinking back all the way back to chapter 6 in financial accounting, we talked about perpetual versus periodic inventory systems. The assumption here is that we use a perpetual inventory system. And so as we sell that product, we're going to move it out of our inventory and onto the onto the income statement as cost of goods sold. Regardless of what type of system or method we use, of course, we have to report the revenue. And if this was sold on credit, it would be a receivable. If it was sold for cash, of course, we'd have a debit to cash. So we sold them for $240 per unit, 480 players at $240 per unit. That's our revenue and receivable. And at the same time, we need to remove those players that we just sold from our finished goods inventory. We no longer have them. And so 480 players at $165 each, that was the cost that we established. Again, that came from the direct materials of $60 each, plus the $105 for direct labor and overhead, combined into one conversion cost calculation. And so we move the cost, $165 each for 480 units, out of finished goods and into cost of goods sold. I want to stop here for a moment. Does anyone have any questions about what we did? So this approach is still the forward-facing accounting. This is not back flush accounting, because we didn't start in cost of goods sold and then push backward. We still went chronologically, step by step. We just combined a couple of the steps. We didn't keep direct labor and overhead separate, so we combined that into conversion cost. We did not keep raw materials and work in process separate. We combined it into one inventory account. So we still see some efficiencies, but not as much as we could have seen using back flush costing. But before I spend a moment talking about that, does anyone have any questions about what we did here? Okay. Let me just very quickly tell you what this would have looked like if we used back flush costing. When the materials were purchased, this debit in number 1 would have been to cost of goods sold. When we applied our conversion costs, this debit in number 2 would have been added to cost of goods sold. It would totally eliminate step number 3, because the goods would actually not go into finished goods when they were produced. They're already sitting, the cost of those goods is already sitting in cost of goods sold. So what would have happened? At the end of the period, yes, we would still record the sale, but we would not need to record this cost of goods sold. So the second entry for number 4 would also be eliminated. What would be added then? At the end of the month, we would say, do we have any work still in process? Well, given what we have here, there was nothing still in process. We made 500 DVRs and we finished all of them during the month. It's probably not terribly realistic that just because it happened to be March 31st, everything was done and then we'll start over scratch, fresh on April 1st. It's probably not realistic, but that's what we're given here. So what would we do? We've eliminated a couple of these entries already. We would make one entry to move the 20 DVRs that we finished but did not yet sell. 20 DVRs at $165 each, that's $3,300. We would move at the end of the month, we would move $3,300 out of cost of goods sold and into finished goods. So it is even more efficient, more cost effective in terms of reducing unnecessary entries when we don't produce just for inventory. When we produce expecting to sell, in this case, most of it, we eliminated several entries and we have just one entry at the end to reclassify, to move out the cost of those units that have not been sold. If there were a few that were still in process, we would move the cost of those back to the raw and in-process inventory. If we had any raw materials, maybe we had ordered, doesn't tell us this, but maybe if we had ordered 550 units worth of raw materials, we might have to move some of that back to the raw and in-process inventory as well. So again, what we did here is helpful to apply those lean principles. It does cut down on our accounting entries that are required. So it is more efficient, but maybe not the most efficient. There could still be some additional efficiencies to be realized there. Let's go on to our next exercise if there are not any questions. So this exercise looks very similar to what we did in exercise 6. So I would like you to try this one on your own. I am going to pause the recording to allow you to try this on your own. Once you have completed the 4 journal entries required, again, just like we did in the last exercise, please find the ending balance for raw and in process and for finished goods. You can use the check my work button and then restart the recording. I will very briefly go through what I have done once I restart the recording. I'm going to pause it now. Please work this exercise on your own. And so as we look at the completed exercise here, I assume I did all my calculations right. As far as using my calculator, I haven't actually checked it yet because I wanted to keep it clean on the screen to go through it. But again, same thing that we did in the last exercise, only maybe a bit more realistically in this exercise, we have ordered materials for we had ordered materials for 2,000 units, but we only actually worked on 1,800, we only finished 1,700, and we only sold 1,600.
So that seems to me a bit more realistic, that we might have some work that's still in process at the end of the month, and we might have some product that we finished and have not yet sold. And so we get a little bit of that more realism in this exercise. But the same calculations are essential. So we start with the $50,000 budgeted for conversion costs. That worked out to be $62.50 per hour, but each speaker only takes 24 minutes. So that's $25 in conversion costs per speaker. Then our first entry was for purchasing the 2,000 speaker units, the raw materials for the 2,000 speaker units. We were told that the raw materials were $48 each. And so 2,000 times 48, we add that to our raw and in-process inventory. We then applied conversion costs for 1,800 speakers at the $25 per unit we just calculated. So that's an additional $45,000 into raw and in-process. So we now have direct materials for 2,000 units, but conversion costs for 1,800 units. We finished 1,700 of those units and moved them out. So the 1,700 units would include both the direct materials as well as the conversion costs at those budgeted or cost standards. Then we sold 1,600. And so here's the revenue at $90 each and the cost at $73 each. Now, the last thing we were asked to do was to identify what the ending balance would be in the raw and in process, and as well as in finished goods. So I took the easy way out. I just said, well, what did we put into that account? We put in 96 and 45. And what did we take out of it? 124,100. And that left $16,900 in there. You may have done it differently. And if you did, it actually shows that you understand what's in there. What is in there is the extra materials for 200 speaker units at $48 each that we ordered and received but have not yet started to use. And then the extra $100 in conversion, sorry, not $100, 100 hours, no, 100 units at $25 each for the conversion cost. And so that's where the $16,900 comes from. You could have done it either way, you get the same answer. And then for what's in finished goods, we had finished 1,700 units, but only sold 1,600. So there's 100 units still in ending inventory. That includes both the materials and the conversion costs at $73 total. Or the easy way, how much did we put into finished goods minus how much did we take out of finished goods? So either way, you'll get the same answer. So before we move on, any questions? I'm going to hit the green, sorry, the check my mark button, make sure we get our green check marks in there. It's always good to know I don't have any math errors. Any questions before we move on? Okay. Let me clear my drawings and we're going to go back to the PowerPoint. I have to bump up a couple. Get that out of the way. So as I said at the beginning of class, we are going to talk about so how do we measure things in a lean manufacturing environment? And we frequently are looking at things that are not financial, which means we're not measuring them in dollars and cents. But the assumption is the things that we are measuring do contribute to the efficiency and the effectiveness of our processes. It might just not be measured in actual dollars and cents as we are accumulating those data. Change pages. Here we go. And so you can see some examples here of types of non-financial measures that we might be gathering to answer questions about how efficient, how lean our operations are. So some of these we talked about last class: lead time, value added ratio, setup time. All of those were focuses of of exercises we did on Tuesday, but you can see some additional measures here that we might want to keep track. Number of production line stops. So we talked about on Tuesday that one of the advantages of the lean manufacturing environment is it does empower workers to kind of be their own quality control. And if they see a quality issue in their or someone else's work, they are empowered to shut things down until it's fixed. So we don't continue to make product that we know doesn't conform to our specifications or our requirements. So one way of looking at quality might be how many times did we have to shut down the line to fix a quality issue? So there's kind of a positive and a negative connotation there. Yes, we're empowered to shut it down, which is a good thing because we don't continue to make poor quality product, but at the same time, it stops production. And so it tells us how often we're having a quality issue, even though we're addressing it. Number of units that are scrapped, I would throw on there, or failed or reworked. So sometimes a unit can be salvaged, even if there's a quality defect, it can be fixed. So it's not just whether we scrap them, but whether we have to spend additional time, labor, maybe materials to fix a defect. Deviations from scheduled production. So if you work in a manufacturing environment, they keep very close tabs on how often shipments are late or delayed. And they do what's called a root cause analysis to figure out why are these things running late. There can be real financial implications. Not only might it take more work, more time than planned or budgeted to create the product, but frequently contracts include penalties for late delivery. And it may be a daily penalty or a weekly penalty past the agreed upon or the promised ship date. And so keeping track of why we get off target, why we might not make our expected shipments is really important when you might be not only incurring additional cost for the labor and materials, but also penalty costs that you have to, you're going to receive less revenue from your customer because of those penalty clauses. Very common. Number of failed inspections, that obviously makes sense. So each one of these is not measured in dollars and cents, but has a clear impact on the bottom line of our organization.
We could kind of figure out a value for it based on how much we lose because of it, right?
It might not be that easy to do, but yes, there's a clear connection. I'll give you a quick example. And it's not in the manufacturing world the way we think about it. I'm on the board of Canticle Farm in Allegheny, which some of you who live in this area may be familiar with that. We had a board meeting last night. One of the things that we are exploring is putting up fencing, deer fencing around the farm. You can imagine how expensive that might be because we're talking about, well, does it need to be an 8-foot or does it need to be a 10-foot fence? The reason we're looking at that is because last year, it happens every year, but last year was one of the worst, maybe the worst year we've ever had in terms of losing crops to the deer. They ate all the beans. They're just, there's a financial impact on the farm because of deer. And so we're trying to figure out how do we control that. And the board has tasked the farmer with coming up with a financial estimate of how much did we lose on an average year, how much did we lose last year when the deer literally decimated the beans. And so when we look at I'm just going to throw numbers out there. When we look at putting up a fence that might cost $50,000 or $60,000 to because it's acres of farmland. And so when we talk about paying $50,000 or $60,000 to put in a fence, we have to know what's the return on that investment. How many years is is it going to take to recoup that investment? Same concepts we've been talking about. How do we analyze this? Then yeah, you kind of do need to have that dollars and cents calculation, even when these non-financial measures aren't measured in dollars and cents. Canticle Farm needs to know, would the fence pay for itself? That payback period question we looked at in the last chapter. Would it pay for itself? How long is it going to take? Is it really worth it? Yes, it killed off the beans, and people like me were, kind of sad last year that we didn't have the same quantity of beans in our share that we would normally have. But if it was $2,000 worth of beans, it's not worth it to put up a fence. So we might just have to, to deal with that loss, or come up with other maybe less financial hardship approaches. So, yes, I would agree.
If you shut down a line, depending on an assembly line or whatever, depending on how long the shutdown is, you're going to be paying the wages for all the workers.
Right.
without
And
getting
you've
the
got lost
work.
production, right?
And then
So-
you're gonna have to pay for whoever comes in to examine the line and stuff like that, so.
Absolutely. Yep. So yes, even though we might be measuring things that are not in dollars and cents, we may not do that if, I'm trying to think if there's a situation that we would do that if it didn't have a financial impact. And I can't really, everything comes down to a financial impact. If it's a question of, well, we didn't have the materials, or we didn't have the product done, and so it wasn't on the shelves, and so we lost sales, or we lost customers to our competition, all of that's financial in the long run. Some of it's really hard to get to what those numbers are. How do we measure what didn't happen? How do we put a number on what we think are lost sales or lost market share? And that's more challenging. But we probably wouldn't be measuring it if we didn't think it affected our financials. Yeah. This slide mentions the idea of KPIs, or key performance indicators. That is a very common acronym or expression. We here at JCC talk about KPIs. So our KPIs include things like success rates in retaining students, in getting students through their degree. Are they successful when they transfer? So we can look at those data. But KPIs are a very clear indicator. They're called key performance indicators because we assume that this is kind of the bellwether for the entire system. And so for us at JCC, we're very interested in the ratio at which students persist in seeking their degree, how many of them earn the degree within what I'm going to call it on time, which for an associate's degree is considered 3 years. So we look at from start to finish, how many people finish their degree within that 3-year period. And we are very aware of what those numbers are and how they might fluctuate, and try to figure out what goes into them. Some of you, maybe many of you, have received either emails or phone calls. I know I personally have emailed several people, including at least one person who's here right now, to say, how are things going? Is there anything we can do? So this is one of, we call it the Continuing Student Calling Campaign. And we are reaching out right now to every student who isn't yet, hasn't applied for graduation, to find out, is there something we can do to help? And it's not a question of whether you're registered for fall. It's just, if you're not graduating, is there anything we can do? So some of you may have received phone calls or emails from people. Some of you I know have received them from me. And that's because that's one of our KPIs. Are our students staying? Is there anything we can do to help to eliminate maybe some barriers to your success? I think we talked last class about the idea of cross-training, making sure that we have everything covered, making sure that our workers are, this isn't probably the right way to say it, but constantly busy. So I talked about last class, one of the examples in that book, The Goal, where they realized that they had someone on an 8-hour shift who might have something to do like 10 minutes out of the 8 hours as he swapped things in and out of that furnace, which was the bottleneck in their manufacturing process. And so we want to make sure that we are keeping our employees busy, engaged in the activity, that they are aware of what is happening in other parts of our organization, other spots in the assembly line, if that's how our manufacturing works, that we're empowering them to do some, maybe some tasks that traditionally have been done by an outside entity, by a support department, that maybe some of that can be done internally. And I think of the exercise that we were looking at on Tuesday, where you had to go to the tool crib to get, to swap out the part for that, I can't remember what the machine was. And you had to go and take the old part and then clean the machine and then go back and get the new part. Well, our idea of putting the tools with the machine is part of this approach of allowing people to do some on their own things that maybe have been done by support departments in the past. So getting people more hands-on on eliminating some of that support department or indirect work. The last part of the chapter deals with activity analysis. And I think some of this we've already really alluded to, if not outright explicitly discussed. But the idea of lean manufacturing is looking at everything that we do to determine what could be improved. So we're looking at a process of continuous improvement that includes eliminating waste, but it also includes preventing costs from occurring. So having a maintenance plan for the equipment, the machinery that we use. We don't wait till it breaks down. That might be more costly. It's kind of like if you have a car, you know that getting regular oil changes and changing the air filters and fuel filters and that kind of thing on a regular schedule are going to extend the life of your car. The same thing is true for machinery or equipment within our manufacturing environment, making sure that it continues to work well. And that might mean, for example, having an annual shutdown where routine maintenance is performed. Many manufacturing companies do have a scheduled shutdown week, at least once a year. Sometimes those shutdowns are timed around the holidays when they know that they won't have a full staff even if they were open. So it's not uncommon to have a shutdown over the 4th of July or over Christmas. And it's planned maintenance to prevent more costly and more lengthy times when we're not able to manufacture. So all of these things that we're looking at now are the costs of maintaining quality, sometimes referred to as the cost of poor quality. So appraisal costs, so checking to make sure that the product that's going out is meeting our standards. There's a cost associated with that. Even if it's our actual frontline workers who are doing that, there's still a cost. There's time and energy involved in that. Internal failure costs. So we know before it's shipped to the customer that there was something wrong with it and we need to scrap it or rework it in order to make it reach our standard. The external failure costs, I would suggest, are even more costly. Not only do they happen later in the process when we've already incurred, maybe the shipping costs and so on,
but they've come to the attention of our customers, which has its own impact. Our customers are clearly not going to be happy with that if the product gets to them before it meets standards. It's not uncommon in large manufacturing facilities that customers will come in and do, I'm trying to think what we might call it. They do an inspection or a check on the progress before the product is done. So they may have built into the contract that they're going to come inspect and do their own quality checks, maybe at set points in the manufacturing process. And so we really want to make sure that they're happy with what they see, that if there is a quality defect, that we detect that and fix it before the customer comes in and detects it independently. Or, as I said, even worse, we ship the product to them and we haven't caught that there was a defect in the product, that it doesn't meet the standards that should have been met. And now we have an unhappy customer. We have additional unnecessary expense of shipping the product out there, maybe either shipping it back to us or sending a field engineer out to try to fix it on the spot. All of that has additional cost, including an unhappy customer. I used to work, and you've probably heard me say this before, for the refinery in Bradford, Pennsylvania, when it was Kendall Motor Oil, owned by Whitco Corporation. And I still have a mug. We had kind of a push toward this concept. I have a mug that says Kendall on one side, but the other side says, it takes months to find a customer and seconds to lose one. And so you really need to keep that in mind. It's true no matter what your job is, no matter whether you think you're front facing to the customer or not, what you are doing in the workplace impacts the customer's perception of the quality of the product. That's true here at JCC. It's true in the manufacturing environment. It's true no matter where you work. Okay, I need to keep going. Give me 1 second here. There we go. Before we get to our next exercise. So we've just spent some time talking about what the costs of quality are and how we might measure them. A Pareto chart is one way of showing our results, of ranking them in terms of the most frequently and least frequently occurring, or if we are measuring this in dollars, the most expensive and the least expensive. And of course, we want to target the ones that occur the most frequently or are the most expensive, that are costing us the most. Those are going to be the focus of our efforts. We aren't going to be as concerned about the quality issues that occur very infrequently and don't cost very much. This is an example of a Pareto chart. Now this is based on dollars, not based on number of times, but we just spent some time talking about non-financial measures. Those could also be displayed on a Pareto chart like this. And so what you see is that to the left, the very first thing that catches your eye is the cost of rework. We're spending $400,000 or $380,000 a year, maybe, on rework. And over here, we spend only about $50,000 assessing vendor quality. So if we are looking for how do we save money, how do we make this less expensive, we want to focus on reducing the need for rework. It is at least 50% more cost than the next highest category. And so that becomes a target for improving our processes. The things that are over here toward the right-hand end, the things that cost less, are going to be the last things we worry about. there's a phrase, the low hanging fruit. If you've ever gone to an orchard to pick apples, you know exactly what that means. You take the stuff that's on the bottom first. It's the easiest to get to. And then we'll worry about the apples that are still in the top of the tree, which would be these lower dollar amounts to the right-hand end. So with that, let's go to our next exercise, which is, not surprisingly, talking about a Pareto chart. So any questions before we look at this exercise? So we're not going to be constructing our own Pareto chart. We are given several different options. I'm going to have to collapse that so we can see them. We're given several options, and our job is to pick which of these Pareto charts is the correct representation of the information that's provided. So it is one of those multiple choice questions, but whoops. But let's take a look. Meager Solutions Incorporated manufactures memory chips for personal computers. An activity analysis was conducted, and the following activity costs were identified with the manufacture and sale of memory chips. And so you can see it's a total of $1 million. As we look at the Pareto charts, we're going to be looking for one that has the activities from most expensive on the left to least expensive on the right. So we should see warranty claims, followed by correct shipment errors, emergency equipment maintenance. We should see that warranty claims is $250,000, correct shipment errors is $150,000, emergency maintenance is $125,000. So take a minute and scroll down through those and see if you can identify which is the correct one and why the others are incorrect. I'm going to pause the recording to allow you a few minutes to look at each one of those. So you should have had a moment to look at each one of the charts. And this is not an easy exercise, especially because there's so much scrolling up and down and comparing. I would point out that in a typo like this, where it says maintenance instead of maintenance, is not the error that they're expecting you to find. So this is what I did. I went down and I started with the highest dollar amount ones, and I immediately saw that in letter D, the warranty claims, the bar didn't reach the $250,000 line, and so it undervalues the cost of those warranty claims because the chart tells us it was the full $250,000. So I eliminated D right away. So then I was left with A, B, and C, and I wasn't seeing anything right off the bat with letter A. So then I was looking at B and C, and I went over to the far end and I said, oh, look, preventive equipment maintenance and supplier development in B look like they're the same cost. And the same thing was actually true in letter C. And so I went back up here and said, what are those lowest two? Supplier development is $15,000 and preventive equipment maintenance is $40,000. So I eliminated B and C based on that the bars should represent the cost, and you should be able to see a clear difference between those two. Now, there were other differences, as you can see, between B and C, but that's the first thing that I noticed.
But quick one for me for B was processing customer returns.
And it's, yep, good point. So B I wouldn't have even needed to check any of them. B couldn't be correct because this one has a higher value than the one next to it, at least the way they've drawn it. And the bars should be in decreasing size order as you go from left to right. So good catch. That definitely could not have been correct. Either one of these bars is missized or they're in the wrong order. These at least are in the correct order, but these last two bars are not the
not representative of the dollar amount. And so the answer is A. Any questions about that? As we move on then, our next exercise is preparing a cost of quality report. And this information should look familiar because it's the same information that we were just given in the previous exercise and asked to put into a Pareto or identify the correct Pareto chart. So in the first part of this exercise, we are asked to identify the cost of quality classification for each of the activities. We saw, I need to sneeze. Excuse me. Thank you. So we saw each of these 4 categories as we were looking at the PowerPoint a few minutes ago. So I will suggest that some of these are a little bit more challenging for us to determine which cost classification is what the software considers correct. As is sometimes the case, we have to do a bit of reading into what is it they're trying to get us. If we worked for this company, we'd know a little bit more than just these 2 or 3 word descriptions for each of the activities. So we'll go through those first, and then we'll make sure we get the right classifications in there, because if we don't get the right classifications, then our cost of quality report will also not be correct. So we're going to get the classifications first. And then we're going to, for each classification, total the cost of that activity so that in our report we can see where are we spending money. Are we spending money on prevention, appraisal, internal or external failure? And one, that will help us see where we can focus our efforts at trimming those costs. But 2, as I suggested, my concern is more with the external failure costs, because that is front facing to the customer and is more likely to have a long lasting impact on the success of our company. When given a choice, I would much rather find any defects, prevent them first. If they happen, I would prefer to catch them before they get to the customer. So correcting shipment errors. It's an external failure because it happens after the product left our plant. Disposing of scrap. So the error happened, we found it, but it was before it left our plant. And so that would be an internal failure. Emergency equipment maintenance. So remember, we said one of the focuses is on preventive maintenance, not fixing something after it's already broken. And so that would be an internal failure because the break, the stoppage happened. Our preventive maintenance program did not prevent that equipment from breaking down. Employee training is clearly focused on prevention, so getting them trained correctly. Final inspection is part of the appraisal process. Inspecting incoming materials is part of the appraisal process. Preventive equipment maintenance is part of prevention. Processing customer returns is clearly an external failure that got to the customer sent it back for whatever reason, presumably a quality issue. Reporting on scrap, same as disposing of scrap. The error has already happened or the quality defect has already happened, but it was while it was still in-house. Supplier development is part of prevention, making sure that we have quality suppliers who are going to send us raw materials that meet our specifications.
And then clearly warranty claims is an external failure. So from that, I'm going to give you a minute, a couple minutes if needed. We're going to group together all of the similar or all of the same classifications. So the first classification is prevention. We're going to look at the costs associated with prevention here. Add those up, enter that as the total cost for prevention. When I added those together, I got $69,000. I clearly can't add. Oh, I put 4 instead of 40,000. Hopefully one of you would have called me on that. 105,000. I'd like to blame my calculator, even though that's not actually true. So percent of the total quality costs. So we've identified $1 million worth of activities that are aimed at improving our quality, either preventing quality problems or fixing them after they occur. Of that $1 million, 105,000 or 10.5% is focused on prevention. As a percent of sales, our total cost of quality as a percent of sales, 1 million out of the $4 million in sales, that's 25%. 105,000 of the 4 million, or 2.6, again, we're rounding to 1 decimal place, 2.6 is focused on prevention. Everybody okay with where those are coming from? I'm going to pause the recording to allow you to complete the next 3 parts of the table: appraisal, internal, and external failure. Once you have those, restart the recording. Okay, so we finished up those lines. I double checked to make sure that adding down gave us 100% in the total quality cost column and the 25% in the percent of total sales that we knew it should be. So let's go to our final step here and answer these fill in the blank questions. The category with the fewest number of quality activities. So what do we have? 3 internal, 3 external, 2 prevention, 3 prevention and 2 appraisal. Yeah, so this, while I had the recording paused, I told people who were here live that I had a feeling that there was something in part C that's wrong.
Yeah, I think it's looking for quality costs.
Yeah, so it's not the fewest number, it's the fewest dollar. It's the lowest dollar amount. That's what it is. Because the answer that gives you that coveted green check mark is prevention costs. So it shouldn't say fewest number of quality activities, it should say the lowest spending on quality activities or something like that. So it's an error in the exercise. Please just choose the one that gives you the green check mark, and know that the wording is wrong. So nearly 50% of the quality activity costs are for external failure. And I told you already, in my opinion, that's the worst one to have happen. I know I tell you, I say these sayings all the time, and I frequently have students say, that's like, I've heard my grandmother say that. I'm not old enough to be your grandmother. Some days it feels like it. But an ounce of prevention is worth a pound of cure. Have you heard that one? You heard your grandmother say that one? So that's where the focus should be. So on preventive maintenance, on catching defects before they happen or stopping them from happening, absolutely stopping them before they get to the customer should be a high priority. The highest single cost is warranty claims, which is an external failure.
Disposing of scrap, emergency equipment maintenance, and scrap reporting are all internal failures. So as I suggested, I had this vague feeling there was something wrong with this, and it is just the wording here. It shouldn't say number of, because the fewest number of is appraisal. There were only 2, but appraisal has a lower, has a higher cost in total than the 3 prevention activities. So again, to get that green check mark, please just choose prevention costs, even though it's not technically correct based on the wording that we have there. And I'm aware that we have just a few minutes left here in class, so I want to make sure that we can talk about this last exercise to finish up the chapter. Statewide Insurance Company has a process for making payments on insurance claims as follows. We've done an activity analysis of those 3 activities, identified the cost associated with each of them. This process includes only the cost of processing the claim payments, not the actual amount of the claim. So this is just the administration of the claim. The adjusting activity involves verifying and estimating the amount of the claim and is variable to the number of claims adjusted. The process received, adjusted, and paid 2,000 claims during the period. All claims were treated identically in this process. So 2,000 claims, $500,000 to process them or to administer the claims. That's $250 per claim when they're treated identically. As they looked at it, they realized that they were spending the same regardless of the dollar amount of the claim. Maybe they were spending more time looking at the low dollar cost claims than they should have. And so they decide to separate them into 2 categories. Claims $1,000 and under, and claims that are greater than 1,000. Actually, I guess it's not clear what we do with the claims that are exactly 1,000, because it says under and over. Somewhere there has to be an equal sign. I don't know which one. So what they decided was that claims under $1,000 wouldn't be adjusted. It's a small dollar amount. Let's not spend the money. Let's not waste our time and spend the money worrying about those small dollar amount claims. And instead, we'll only focus our attentions on claims above $1,000. The fact that it tells us that they're variable means that if we stop doing some of the activity, our cost will go down. So these are not fixed costs, they are variable costs. And so if we reduce the level of activity, we can save money. It's estimated that 80% of the claims are under $1,000 and thus would be paid without adjustment. So our biggest cost here is adjusting the claim. We're spending $260,000 on that. And we've just made the decision or determination that 80% of that money could be saved. We don't have to spend 80% of that. It's also estimated that the additional effort to segregate claims would add 10% to the receiving claim. So it was costing $120,000, but now when we have to divide them into under and over $1,000, it's going to add a little bit to that cost, but we're going to get rid of most of this cost. Excuse me. So what we're going to be doing is calculating the cost per claim and then showing whether we could save money based on what I've just described. We have 2 minutes left. So I'm going to ask you to just complete this on your own. You can use the check my work, of course. There's also a show me how up here. If you have questions on that, use the show me how, and then you can email me if you're still stuck. I think you'll be fine. I know you'll be fine because I just explained what it is that you need to do. But if you have any questions, let me know. I don't want to hold you late, and it's 1 minute until the end of class time. So any questions, comments, anything before we call it a day? All right, well, thank you all for being here, and I will see you on Tuesday.